Welcome to Insights for Business Owners. And this episode, we're psyched to have Avnit Sekhon from Treewalk, which is a mid-sized CPA firm. And Avnit runs kind of the quality of earnings work there, buy side, sell side. He knows all things ETA. So we're excited to get his thoughts on the market right now.
Yeah, appreciate the intro, Dave.
Yeah.
Glad to be on the podcast. And like Dave said, I'm with Treewalk. We run the kind of the quality of earnings and the M&A and buy side, sell side DD arm of the firm, at least.
Awesome. Well, let's jump right in because it is a kind of a funky market right now. And what are you seeing on your deals in this, climate?
Yeah. Anecdotally, Dave and I were just talking kind of offline before we got on this podcast. Is the last month or two, we've seen softening revenue and EBITDA numbers on a large percentage of our deals, much larger than we have in the past, especially compared to 2024. So I was also talking with a previous client of Treewalks yesterday, and he was telling me his business is on par this year. And I laughed and I said, you're probably ahead of 85% of the businesses that we're seeing.
Right.
The market just hasn't been as strong for a lot of lower mid-market and SMB and ETA businesses. Deals are still getting done. I think buyers just have to be more cognizant of what's out there and what's happening in the market. And there should probably be an expectation going into the deal that, hey, my numbers might not be as favorable. There might be softening in 2025. EBITDA drops, revenue drops. I think as a buyer, it's probably more important in this case to be extra diligent almost, or you always want to be diligent in every market. But the market where there's decline, and the big reason is you want to make sure companies, like you do construction businesses, you want to make sure the WIP is right. Who are their end customers? Are they selling to builders? Are they selling to developers? Who are they working with? And what are their macroeconomic environment look like? What is their what do their conditions look like? And that really plays a role into the windfall of other SMB businesses, right? And so the unfortunate part of being in SMB space and ETA space is you're generally reliant on a few industries and a few players, and you get the tailwinds of kind of how their business is running. So I think being extra diligent and being almost prepared for a slight revenue drop and EBITDA drop is kind of the name of the game right now.
That's really interesting. And I never thought, because I think of, quality of earnings, a proof of cash, and things you're doing are just purely in the books of the selling company. But what you're telling me is you've got to be thinking a little bit about macroeconomic, issues, trade, tariffs, interest rates. Do you take that stuff into account as you're looking at a seller's company?
Yeah, absolutely. I think it's a large part of our engagement. And I think I tell folks this all the time. When you get a quality of earnings and you get a quality of earnings provider, you have to understand what they're going to do, right? I think most providers can provide an output. They can provide a data book. The data book is not the big reason why we're there. It's the information that goes into the data book and the qualitative aspects that build the story around it, right? We want to make sure that when we provide a quality of earnings, there's sufficient amount of work going on behind the scenes, seller meetings. I rarely do a quality of earnings where I don't get a chance to speak with the seller. And sometimes brokers will say, hey, listen, I can answer the questions, or you got the information you need. I was like, no, let me get the seller on the phone, because I find in lower mid market and ETA businesses, once you get a seller on the phone, it changes everything. The amount of information they tell you, how they tell you they run the business. They'll tell you their own risks. They'll tell you why they're worried. They'll tell you why they're selling, right? And I think a lot of sellers right now, they're selling because there's just so much going on, right? Dave, you and I were chatting about all the uncertainty in the markets, and it's a good time for sellers to get out. They just don't want to deal with it, and they'll tell you their risks when you get them on the phone. And so I think a big part of our job is to understand, okay, like when you're selling your business, why are you selling it? And then your risks, right? What is your customer concentration risk? Not only your customers, what are their risks, right? What's their risk that they're going to drop as your customer?
Wow.
I think that those narratives are kind of the big purpose of the quality of earnings, right? Like in the lower mid market, especially, they're way more important than they are in the mid market. Mid market, you can do a lot of tick ties, GL reconciliations, all that fun stuff that you want to see in a QV. But really, in the lower mid market, you need to spend way more time on the qualitative and
on the qualitative, not the quantitative.
Absolutely.
Interesting. And I don't, people go and do their Q of E before they talk to us, really, or before we get involved.
Absolutely.
We tell them to do that,
Yeah.
because the deals break at quality of earnings,
Oh yeah.
So we're
Absolutely.
like, we don't get in, we don't get involved before. So I just always thought of it as just pure numbers. Like I like, oh, you're just confirming that the numbers are true. But it's
Yeah.
way more than that. It sounds like. So actually, why don't you explain what is the quality of earnings? I think we
Yeah.
need to go there. I
Yeah.
thought I knew.
Absolutely.
Here I am, but I don't.
Yeah. There you go,
Yeah.
man.
What
And
is the tree walk quality of earnings? I think that's probably more important.
yeah, and I love how you emphasize that because I always tell
Yeah.
everyone when we start a conversation is what quality of earnings means to me, what it means to you, and what it means to another provider can be three vastly different things.
Well,
The
it is. Yeah.
ultimate reason for that is a quality of earnings is not an audit, so there's no set standards. You don't have to do anything in a quality of
Really?
earning. There's
What?
no
You're
obviously you
lying.
have to, yeah, you have to adhere to CPA standards, but there's no set standard you need to meet. There's no threshold. There's no materiality threshold. There's no guidance really, right? It's a
I did not
consulting
know
engagement.
this. I thought it was like
Yeah.
everybody's was
No.
follow the same rules. No.
Yeah, yeah. I mean, you would hope so, but it's not the case
Yeah.
at all, right? And so you get
Wow.
folks that say, "I've got a quality of earnings from my tax guy at $1,500." Like, okay, well, it's not a quality of earnings, guys. He just
Yeah.
tick and tied a few numbers and maybe asked him why their revenue is increasing or decreasing. And then you get the full quality of earnings at big four firms, which are very in depth, but they're more suited to mid market companies, not the lower mid market. And then you get this middle part, the lower mid market, where you have you need to have enough information on the quantitative side. You need to make sure your proof of cash matches. You need to make sure your GLs reconcile. You need to make sure what the seller's telling you is actually happening. If they say they're not taking deposits, that means they're actually not taking them, and all of that. They're deferred revenue, revenue rec. The way they're recording inventory on the balance sheet, is it in adherence with accrual basis, or what is it to adhere to, if anything at all, right?
Hmm.
Once you've got those answers, and a lot of the answers you might not like, you try to get everything from the seller. You try to hope that it's all right, but in ETA and SMB and lower mid market, it's usually not the case. It's understanding the risks of having that missing information, or going back to your buyer and saying, listen, we're unable to kind of confirm this, but I think from our experiences, doing cash basis for COGS and inventory is very typical for businesses this size. I don't expect them to hold it on the balance sheet, just the way the businesses operate. And so
Yeah.
that's why the qualitative comes into the picture, right? Because you want to
Hmm.
make sure that you're not getting everything you want from the Excels. You're not going to understand the business fully from just the general ledger. You need to put
Hmm.
two and two together. You need to talk to the seller. You need to talk to the seller's controller, hopefully. You need to talk to people in the seller's team, management. You need to understand what their jobs are, their roles are. You need to understand where the gaps are in the process, right? Like, where
Hmm.
is there opportunity for mistakes? Where is there opportunity for fraud? And understanding
Hmm.
that allows you to kind of put it into the QV on the backside. And so I think the Treewalk process is very much qualitative and quantitative, and it's
Hmm.
very much focusing more on inputs rather than the data book. I mean, the data book it's a commodity almost, really, if you will, right? It's not difficult to put together
Hmm.
an Excel data book. You could do it in a few hours, or you could do it in a lot of hours, right? And really the
Yeah.
difference is the inputs and what you're actually doing to verify the numbers or get comfort around the numbers and get the story behind it.
And so sometimes you see a business where the EBITDA is great, but then there's all these other qualitative factors that you maybe
Yeah.
even really highly recommend that a buyer even walk away or be just very skeptical.
Absolutely, yeah. I think there's when the EBITDA is great, I mean, most of the time it's fine, but there are cases where the EBITDA is great, and then there's certain reasons for it, right? You're tied to one developer who did a really big project of,
Mm-hmm.
1,000 homes, and you're one of their construction guys, and they're very much tied to that buyer and their work. And if they don't have a big project coming in the pipeline, well, then your EBITDA is probably not going to be sustainable. So as much as you care about previous EBITDA, I care about that a little bit less than I do about future EBITDA, right? I want to confirm previous EBITDA, but really our goal in a QV
Mm.
through the conformatory process and all of that is to understand what's my new EBITDA gonna be, and
Yeah, so
that,
projections. Okay,
that's it.
okay,
Yeah,
okay.
that's it, right? And that's our goal, and
And
that's what we do: pro forma stuff, run rate stuff. Is just to make sure, what does the future look like for the business.
so that's modeling based on history and then a qualitative aspect to it.
Absolutely. It's modeling based on what are the historic spend, what are the tailwinds that the business faces, how do we address it, how do we come out on the other side of this, and what is the future going to look like when I take over the business. A great example of this is carve outs. every time we do a carve out, someone comes to me and says, there was a situation this year, and somebody says, well, there's one general manager managing three plants. Well, if you're carving out all three, you're still going to need one general manager for each different plant. So it's
Right,
not a
right,
1 to 3, it's a 1 to 1 three times. And
uh,
something like that, it changes, right? Because your historic EBITDA might say one thing, but your future EBITDA is going to be vastly different because the business is
right.
operating in a different way. And so
Mm.
that's just an example of things we see, right?
Can I ask you? We see this a lot, and I've wondered, when do you use EBITDA and when do you use SDE?
Yeah.
And
So
maybe even
I
explain what those are. Maybe yeah.
absolutely, yeah. So I've got a funny quote. So SD is when you're buying a job, and EBITDA is when you're buying a business. But
I see.
uh,
Yeah.
they're used interchangeably and they're used a lot. So SDE is when you add back all of the seller's personal salaries, personal perks. Maybe they have their wife on payroll, kids are on payroll, and you get an SDE number. And
Yeah.
EBITDA is the number where you have the seller's salary remaining in the business at a normalized level, a
Yeah.
replacement level, and you've got the EBIT of what the business is running with the
Yeah.
seller being an employee or working there. They're vastly different things. And SDE is tough because a lot of times people present SDE numbers, and the SDEs are going to trade at a lower multiple than EBITDA, of course, right? And
Yeah.
if you've got a business that's got SDE attached to it or SDE on the SIM, then the seller's probably heavily involved. They're
Right.
using a lot of ad backs. They're using a lot of
Yeah.
perks through the business. They're
Yeah.
running it kind of like they have the right to as well, like they own the business, and because they do,
Yeah.
right? And so
Yeah.
it's not a terrible thing. You just have to look at it a different manner, and then you have to make sure that, hey, if I'm buying this business and I'm doing STE, I
You're
better be
gonna do it.
working. I better be working the same as the seller, or if I want to replace them, I've got a
You
replacement
got
salary.
no
Yeah,
cash flow. I mean, basically, after
exactly.
you cover the loan, like, yeah. No, I
Absolutely.
get that. That's just like small business job replacement, basically.
Absolutely. Yeah.
Which isn't a bad thing. I mean, like, sometimes these are great job for,
Oh, for
like
sure.
it's,
Yeah, and
it's,
100%. If there's opportunity as well, I mean, it's sky's the limit, right? I mean, there's
yeah.
opportunity risk in every business, but if there's a strategic reason to buy that business, regardless of SD EBITDA, I mean, just obviously you want to make sure you understand what you're getting and you're prepared for it. But
Yeah.
if you are, then well, the sky's the limit in that case.
And the multiple on SDE is just much lower because it's just really not scalable or necessarily scalable.
Yeah, 100%. And you're really pulling everything back. You don't have a replacement salary for the seller. You're going to be in
Yeah.
that business. If you are in that business, you're hiring somebody and you're dropping your SD probably by half. You got 400K
Yeah.
SD business. You need to hire someone to replace a seller. That's 200K. What does that leave for your debt payments? What does that leave for your loan payments? So it's just a different way to look at it. I
Hmm.
think you just have to make sure you're not caught up and think they're the same thing, and think that you as a buyer can still be passive the equal amount in
Right.
SD and EBITDA and still get the same results, because that's not the case. So you just got to be, as long as you're aware of it and you understand it. And
Yeah.
obviously, like Dave, if you're working on a deal or somebody, a QV provider, I'm sure at some point one of us will tell the seller and make sure, or the buyer, and make sure they're aware, right?
Right. Now we work on smaller deals too, and obviously people are very price sensitive, and so sometimes people say, "Well, Dave, I don't know if I need a full quality of earnings, whatever. I'm buying $1 million enterprise value Amazon FBA business,
Yeah.
but is there something else that you provide that would be helpful for them when it's a simple, especially like just a pure ecom like that, sort of payment is from one source, maybe it's Shopify, something like that. What else can you offer them?
Yeah, absolutely. I think for businesses that are a lot simpler, we have a QV Lite. We have a QV Lite, and I think that's applicable to a lot of lower mid market deals. But businesses that are even simpler, when they've got just Shopify, e-commerce, one
Yeah.
source of revenue, the focus is going to be a lot on the expenses side, just to make sure that you're capturing everything. Again,
Mm.
proof of cash you always want to do, and you always want to make sure that they're checked out on the P&L from the expense side. They're not omitting anything. Everything's accurate. Make sure the balance sheets, do they have inventory? Do they have to hold? Are they at 3PLs? How are they shipping? Things like that. Understanding the supply chain risks, like where are they getting
Yeah.
their stuff from? Do they have to, kind of like I said, if they're shipping in different countries, is there 3PL in each country? What are the SKUs they have? What are the risks? When are they paying the deposits for that? When are they collecting the revenue? So I think the shift in focus changes on that sort of QV, where revenue might not be the highest risk area because you're able to tie it pretty easily to
Yeah.
Shopify,
Shopify.
and
Yeah.
you get a
Legit.
lot of customers at smaller dollar values. You want to
Right.
make sure what's your ad spend, what's your customer acquisition cost. So I think that's in a situation like that, a QV provider is actually kind of nice because you're not spending so much time focusing on verifying revenue. You can focus on a lot of the metrics that you want to see in the business. You want to
Mm,
see what's the lifetime value of a customer, what's the acquisition cost, what's the supply chain risk. There's a lot of other areas where a QV provider can focus on in a
mm,
situation where revenue isn't the highest risk. And that's applicable to every business, right? It's understanding what's the highest risk area. If it's not
mm.
revenue, if it's not inventory, which are usually the two biggest, then you can kind of move to other areas and then you can spend more time doing analysis, really, right? Which you don't get a
Yeah.
lot of chance to do in SMB. And sometimes folks
Yeah.
that come up to us all the time, they're like, "Can you calculate these ratios, or is my business target under IFRS or US GAAP?" And I tell them, guys, it's not under either. It's under. You're lucky if it's under cash versus accrual. The business is $3 million.
Yeah.
You're
Yeah.
not
Yeah.
you're not getting this. You're not getting your ratios. You're not getting your perfect 20 ratios you want to see. It's just not going to happen.
Do you see any gap businesses in this market? I mean, I don't.
I
Like,
mean, I've never seen a. I don't even think I've seen audited statements. I've seen reviewed
right,
statements
right.
twice, maybe, and even
Yeah,
then, reviewed statements I'm not a big fan of. Audited, I've never seen.
right,
So really, we're just taking kind of. Sometimes we even have to reconstruct a P&L or balance sheet if it's really bad.
right. Yeah, yeah. No, definitely. Um, One of the things that always seems to be an issue is working capital. And how is that a part of your analysis? And how can we, all of us, do better at like bringing this issue to the forefront, making sure there's not all this confusion around it and anger around it. And I don't know if this is what your experience is, but every deal has this problem. I mean, I don't know. So maybe you could speak to kind of working capital stuff.
Yeah, I echo your sentiment that every deal has this problem because a
Yeah.
vast majority do, and it's unfortunate, right? And I think how do we mitigate this is one, have the conversation early and
Yeah.
often, right?
Yeah. Yeah.
Have it
Totally.
early so that everyone's aware, and have it often so it doesn't slip on the back of the mind. And unfortunately, we had a case a year and a half ago where we had the conversation a few times, and then coming close, seller goes, "Oh well, I didn't really understand that's what it meant, that I'd have to
They always
leave
say
back
that.
on it."
Oh, I didn't
And it's like, no,
understand.
but you've told us 3 times that you understood, that we got it. And so that's a situation where we went back and we reflected and said, listen, we had that conversation early. We had it twice. That's not often enough, though. We need to have it sometimes 5, 6 times before
Right.
seller can grasp, and really just bolding out, what does this mean for you and what does this mean for me? And
Yeah.
so,
Yeah.
as a buyer, for example, if
Yeah.
the thing you can do to get ahead of is, if you see a sim, we saw a sim earlier last year, and it had a balance sheet on the sim with no accounts receivable and no deferred revenue. Okay, right away,
Right.
that's impossible. You either have AR or you have deferred, unless you're getting paid right on the spot, which wasn't the case for this business.
Right. Right. Right.
And so right away, the balance sheet's wrong, and this
Yeah.
expectation of the seller and broker going into this deal is not going to be aligned with leaving working capital or understanding it. So in a situation
Right.
like that, as a buyer, if you see that, it's okay. I need to have this conversation first, maybe right after LOI, in the LOI,
Yeah.
while I'm submitting the LOI, and maybe all 3 times, right? And
Yeah.
really understanding, because working capital is the lifeblood of these businesses, especially lower mid market businesses, especially
Right.
ETA businesses, especially ones that got, if you're in construction, you got retainage on your invoices. That's 10% of your AR
Yeah. Yeah.
sitting, right?
Yeah.
That
Yeah.
can be your entire profit margin sometimes.
100%.
Sometimes you got customer churn, like we did a deal, and there was a large customer. It's 180 days, and
Yeah.
so you
Oh,
can
geez.
imagine, right? Like they're a very large customer, so they can dictate terms, but
Yeah.
you can imagine what that looks like from a
That's
cash flow.
brutal. That's
Yeah,
brutal.
yeah,
Well, and the thing, yeah, I mean, so one trick I'm doing is with LOIs, trying to really define very specifically what working capital means. So we're
yeah.
at least all starting from the same definition. If it's going to be current assets minus current liabilities, fine. Let's put that out there. Um, but I mean, one thing about the valuation, it's kind of a funny thing, is like, is this a valuation that includes working capital or is it not? And I feel like you could do it either way. And I think what's really not explained well to the seller, probably because the buyers want to get the deal, is they make it look like they're actually getting a higher purchase price, but they're actually not, because it's going to be like working capital is going to be subtracted. So some of it also feels like a shell game a little bit. And if you were honest about it, they'd be like, wait, no, 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 I'm getting $500,000 less. I don't know if that's
Yeah.
the way you see it, but in some ways they're sort of financing working capital, and why not just like offer a lower price and get a line of credit? I don't know.
Yeah, absolutely. I totally agree. If the business, sometimes in Main Street businesses, I tell folks, guys, I don't know if you can get working capital, just offer less, come with your own
Yeah.
line of credit, get an SBA Express line with it.
Yeah,
I think those
exactly.
cases have to be, to your point, they just pay a lower multiple and bring your own working capital into it, or pay a lower price and bring your own working capital. But
Yeah.
if you are paying that premium, you are paying that EBITDA that's inclusive of working capital, then
Right.
okay, then that business expectation is it should come with
Sure.
working.
But I feel like we could avoid so many problems doing it the first way, just like not make it complicated. And some of it is,
Absolutely.
you get all these like PE people, and they're like, well, this is the way it's always done in PE. It's like,
Yeah.
yeah,
Oh, you're selling at
it's
15x. These guys are selling at 2.5. So like,
well, there
it's
you
so
go too. That's true too. There's a different multiple. But also like
yeah.
this, little plumbing business, they don't know that. They don't, I mean, and I hate to see the the language uh that it's just like standard normalized working capital. It's like that is the most meaningless phrase to anybody. Like nobody has any idea what that means. I don't know.
Yeah. And
let
you know what?
let, let
It's funny, Dave, to your point is that concept and that term is not well understood amongst professionals, let alone amongst mainstream and lower middle market business owners. So if you
that's what
can't
I
get,
found. There's
yeah,
a million different definitions. Like it
yeah,
could be defined, I mean, it could be cash. Like sometimes it's just like, oh, it's cash in the business, current assets minus liabilities. Sometimes it's just net AR. I don't
yeah,
know. That's what I see. And I'm like, wait, how could these all be that? Like,
and
can we,
so
you
totally
know?
to your point, I had a funny story where we worked on a deal where working capital, everyone said current assets minus current liabilities,
Yeah.
fine. And then where I found they went to their tax CPA did current assets minus current liabilities, and lo
Yeah.
and behold, in current liabilities, they had a massive line of credit that brought working capital to zero. They're like, yep, current assets minus current line of credit. That's current
Yeah.
liability. For definitionally, they're correct. Current
Sure,
assets
sure,
minus current
sure.
liability.
Yeah, yeah.
Well, obviously, like M&A, they didn't do net debt, so they didn't pull out their line of credit. And trying to explain that
Right.
concept to a tax CPA or another CPA, I had troubles. They didn't understand that. Like, this is current asset, current liability. This is working capital. I was like, well,
Right.
no, you've got a 2 million line of credit. You got to pull that out, and now you got 2 million in
Right.
working capital need. But that's a
Right.
professional to a professional, and we're struggling to come to an agreement
Yeah, yeah,
because
yeah.
they're a tax focused CPA, not an M&A CPA, and they didn't understand what that meant. They definitionally did
Yeah.
it right, but they did it wrong for the transaction, and that created a big problem. Kind of the deal still closed, but it wasn't a fun conversation to have with the seller.
Right. Well, the other trick, I don't know if you've seen this. The other problem I've seen sometimes is okay, current assets minus current liabilities. They lard up the inventory, and then you have no AR, and they're like, "Bye bye," and
Yeah,
the buyer's like, "Wait, I can't turn that inventory into cash for quite some time, and I got no AR coming in."
absolutely.
So in some ways, I don't know what you think about this. I like, yeah, if you're gonna actually put it in, I think net AR. I don't know. Is that just like a simple concept? I mean, that's like a moron like me can understand that. I don't know.
Yeah, absolutely. I think it would have to depend on the deal, the size, and kind of
Yeah,
what's going
of
on
course.
in that situation. And if it
Yeah,
works, absolutely, it's a simpler term. And to your point, as a buyer, I always like to say, sometimes a buyer will say, "Well, the seller's going to leave cash. Is that better than here?" I was like, "Yep, absolutely, because you have that day one." And so the
yeah,
most liquid assets going up, and so to your point, cash. Then you want AR, then you want inventory, and inventory is always
yeah.
tricky because a lot of it could be obsolete, and that's why I tell buyers,
Right,
you got to make sure
right,
you're on site. You got to make sure
right.
if you don't know the industry, you have somebody who does to check the
Yeah.
inventory. Make sure if they're saying you're getting 1,000,001, it's actually 1,000,001 at cost and not 500K because half of that's been sitting for 10 years.
Right. Yeah, no, and right, exactly. Then you've got to like really deep dive into inventory.
Yeah.
And the piece that I don't like about that is in an asset purchase, presumably inventory is actually just all of it's coming anyway. And so I feel like it should be separate, like should be separated out of a working capital calculation. All this to say, but when you bring up, hey, we just want cash, they're like, oh, that's not market. The number of I don't know the number of times you hear that phrase. Oh, that's not market. Oh,
Yeah.
okay. It's like, well, but this is what we want. I don't
Yeah.
know. Like,
You probably hear a lot more than I do, given you guys are kind of
oh,
a lot of times we're, in our role, we don't have to negotiate as hard with we have to do it
yeah,
with the
yeah, yeah.
seller. and they usually don't know what
Yeah.
market is, and so they just say, "I don't think that's right." We hear that a lot, but
Yeah, yeah, yeah.
market
Yeah,
is
yeah, yeah.
probably more of a legal term for you and the seller's counsel.
Oh my gosh, it's such a funny phrase. Avneet, this has been so informative, and I apologize. I just decided to just take the opportunity to ask you all my questions
No, I love
personally
it. Yeah,
of things that I run into because we are sort of siloed, and your world is foreign to me. I mean, I know a bit about it, but we're down the line of downstream of this stuff, and it's confusing. And it's helpful to know that even for the professionals, it's confusing because I tell you, the non-professionals like myself are very confused.
yeah. I know. I appreciate this compliment. Even Dave, you and I have worked on a few deals together, and to your
Yeah,
point, we haven't even seen each other's work that closely. We kind of communicate, but
right.
it's not as in depth, I guess, as understanding each other's work really.
Yeah, and we probably should, there probably should be a little more
Yeah.
synergy because it is interesting that the qualitative aspect. I mean, I actually almost never get to see the quality of earnings reports.
Right.
I should ask for them because the qualitative aspect would be really helpful for our legal due diligence.
Yeah. 100%.
Um, a lot of what we're looking at, there is some overlap. I mean, it's maybe not legal, but we are thinking about business risk, operational risk, especially around like you said, the trade, the inventory, tariffs, all this stuff. I mean, the number of times we bring this up to people and they're like, "Oh yeah, I didn't think about that." Like we're,
Yeah.
all our main only suppliers in China, and it's like, yeah, do you read the news? I don't know. Like,
Yeah.
you
And
might want to.
if you're buying a business, you should probably know that. And that's the funny thing. You get that. I get that all the time. Sometimes I always tell buyers you don't have to fully understand a P&L and balance sheet, but you need to be able to read one. And if you can,
Yeah,
if you're buying a business, you better figure
no,
it out or you better wait. One or the two.
yeah. Right. That's pretty aggressive. Like,
Yeah.
I mean, talk about the belief in oneself. Be like,
Yeah.
nah, I don't need that. I got this. Yeah.
Yeah.
You definitely need Treewalk if you
Yeah.
can't read a P&L and balance sheet.
But
What's the best way to find you online, Avneet, for our listeners?
yeah, I think LinkedIn, my name, just search it up and I'll be there. Tree
Yep.
Walk.
Yep.
Search our
Awesome.
name in Google, you'll find it there. So there's a lot of avenues, but
Cheers.
LinkedIn's probably the easiest and probably simplest one.
Awesome, man. So great to chat with you. Thanks for sharing so many great ideas.
Yeah, thanks for having me on, Dave. Appreciate it.